Hi everybody, today I want to show you the next stage of technical analysis, patterns. It's a pretty big topic, so I decided to divide it into 3 blocks. I hope you already seen my previous videos about trends and levels. If not, please check them, and only after it you can start with this video. And before we start, I want you to hit the subscribe button to be always up to date. Don't forget to share this video with your friends, and if you have any questions, feel free to write them down in the comments below. Chart patterns are areas on the chart where a trend move is slowing down and making pause. You can see the price consolidation and the formation of certain graphic patterns. In that area, traders open or close their positions, fix a part of the profit, or add more margin. That eventually leads to the price fluctuation, which you can see here on the chart. You should also understand that patterns represent some sort of consistency on the chart. In chaotic market conditions, sometimes chart patterns can appear and they are predictable, repetitive models. When you see any sort of pattern, you can predict further price direction. I use them not alone. To make successful analysis, you need to combine different tools, and one of them is patterns. Also, I need to highlight to you that any pattern will not give you 100% guarantee of profit. You must make your backtest, develop your own strategy, and accept stop losses as a part of the process. So let's take a look. What are the types of patterns? The first type is a continuation pattern. Here you can see just an example of it, and here we can say that it's a downtrend. Then we see a kind of consolidation, and after a breakout and we have a signal, we see that our price moves forward downtrends. So it's a continuation pattern. Clear example. Next type is reversal patterns. It's one of examples is double bottom. You see that price moving down is a downtrend, and then we see a double bottom, and after that you see price moves up. So it was a reversal from downtrend to uptrend. And the third type, it's patterns which can work in both directions. For example, this triangle which we see, so here we had uptrend, then sort of consolidation, so pattern, and then we have downtrend. In this particular situation, this pattern was working like a reversal pattern, but the same situation is here. Our reversal pattern triangle was working as a continuation pattern. It was an uptrend, then pattern, and then uptrend again. So we might say that these kind of patterns are patterns which works in both directions. You also should know general features of patterns. The first one, that patterns are fractal, so they can be found on every time frame. In our examples, we had 4-hour time frame, 1 hour. You can also find patterns in 5 minutes, 15 minutes, whatever you want. You can always find this pattern on the charts, and they work equally. And the second is pattern is not complete or activated until an actual breakout occurs. So you do not open your position somewhere in the middle of the pattern, like here or here, you decide, yeah? No, you have to wait to the certain position to form. You do not open inside any pattern. You wait for your signal, you wait for the actual breakout, you put your stop losses in the proper way, and only after that you can say that you have a really great position. Today I want to start with you with continuation patterns. Actually, there are only 2 of them. So let's start from ascending triangle. This one is bounded by resistance level, or it can be bounded by resistance zone, whatever. You can also see that we have sort of uptrend. Our lows are getting higher, and this means that we have a lack of selling power. And also we see that this resistance level, and we can predict that there are stop loss orders of sellers here, which means buy orders. So buy orders means pump afterwards. So price more commonly will break this pattern upward. That's why we say this is like a continuation pattern, but it's like most commonly, not 100% guarantee. Remember that. And how you should find your target price? You just take the distance between the highest and lowest peaks of the triangle and add it to the breakout point, okay? Add it like here. So it will be your target price. And you have to put your stop loss below opposite side to the breakout border. So we have our breakout here, you put your stop loss here, and your target price is here. It's your position, you have to memorize it, you have to practice it and make some back tests before starting anything with your money. There is descending triangle, also continuation pattern, but when we speak about downtrend, so it means we had a downtrend here, then we have sort of consolidation, and then our move is going on down. So it also have a support level, or it can be support zone, and you should understand there will be stop loss orders of buyers here below this zone, which means sell orders. So when it will be broken, we will see some dump. And we see the lack of buying pressure because every high is getting lower than the previous one. The rules of stop losses and the target price are the same, so you should take the distance between the highest and lowest peak of the triangle and add it to the breakout point, okay? It will be your target price here. And put your stop loss above the opposite side of the breakout border. So like here, and here you have your position. Memorize it and use it. Let's take a look on the other continuation pattern. It's a bullish flag. This one is bounded by two parallel lines. It can be zones also. You must understand that on each line we wait for 2 or 3 touches. So here we have 3 touches, and here we have also 3 touches. It can be 2 or 3, more better. Before any flag, you should see this big candle moving upwards, and after we see some sort of consolidation and moving into the trend direction. Where you should put your stop losses. You put your stop losses below the opposite border and put your target price like the distance of this flag stock. So here's our target price, okay? You should pay attention to this kind of flag that we have like 19 degrees angle. It's also okay when you see this type of bullish flag. It's not like lines, it's more like trend lines, and the angle is less than 19 degrees. But avoid this type of bullish flags where you see that angle between the flag stock and the consolidation part, where this angle is more than 19 degrees. It's not so good. And the same situation with bearish flag. You see that price going down, it's a downtrend, and you see this big candle, then you see kind of consolidation here, and you wait for 2 at least or 3 touches on each side. It can be zones or it can be lines. And after you see the breakout, actual breakout with normal candles, everything's fine, you open your short position, you put your stop losses above the opposite border, and your target will be the same as the distance of this candle, okay? So it will be your target price, like this. You can also use the same rule with angles. So here we have 90 degrees angle, it's good. Here we see less than 90 degrees angle, which is also good. And here you see the angle which is more than 90 degrees, which is bad. Avoid these bullish flags. That was all for today. I strongly recommend you to find these patterns on the chart, and before using any strategy, don't forget to test it on your own. If you guys have any questions, write them down in comments below, hit the subscribe button and share this video with your friends. See you next time.